Hello, fellow investors, and welcome to another exciting episode of our financial journey. Today, we have an investment strategy that's not just powerful, but also a favorite among seasoned investors. We're diving deep into the world of dividend growth stocks. Now, you might be wondering, why should I care about dividend growth stocks? Well, my friends, in the ever-evolving landscape of investing, one thing remains constant: the pursuit of financial growth and security. And that's where dividend growth stocks come into play. Picture this: generating a steady stream of passive income, watching your wealth grow, and having the confidence to say, "I invest like a pro." You see, there's no one-size-fits-all approach, and understanding these models can give you a powerful edge in the market. So, here we go. Our first model, deep value investing, is like digging for hidden treasures in the stock market. It's all about finding stocks that are trading below their intrinsic value. Meet Sarah, a shrewd investor who swears by deep value investing. "I've made some of my most significant gains by spotting undervalued stocks that others have overlooked." It's like finding a diamond in the rough. Now, let's talk about value growth investing. Meet Alex, a dynamic investor who believes in the long-term potential of companies with strong growth prospects. "I look for companies with innovative products, expanding markets, and a bright future." It's all about riding the wave of growth. Now, let's dive into dividend growth investing. Meet James, a seasoned investor who's all about building a passive income stream for the long haul. James knows that investing in companies with a history of increasing dividends can provide a reliable source of income, year after year. 3 different investors, 3 unique approaches. Each model has its strengths, and the key is finding the one that resonates with your investment goals and style. First up, we have the startup stage. Think of this stage as the birth of a new investment opportunity, much like the birth of a startup company. Company A is at the very beginning of its journey, just like a fledgling startup. This stage offers both unique challenges and exciting opportunities. Challenges include higher risks, uncertainty, and the potential for substantial losses. But, it's in this chaos that you can find hidden gems that may grow exponentially. Next on our journey, we arrive at the growth stage. This is where Company B, much like a flourishing business, is experiencing rapid expansion. The growth stage is characterized by surging revenue, increasing market share, and a bullish stock performance. It's the golden age of an investment. Now, we enter the maturity stage. Company C has established itself as a market leader, much like an established corporation in its prime. During this stage, investors often focus on income generation through dividends. Lastly, we reach the decline stage, where Company D reflects the decline of a once thriving business, similar to investments in companies past their prime. To navigate this phase wisely, investors should exercise caution, consider diversification, and plan for an eventual exit strategy. Now that we've explored different investing models and stages, let's dive deep into the financial performance of dividend stocks. First up, we've got revenue. It should be growing consistently over 5 to 10 years. This is a sign of a healthy, growing business. You can calculate it by taking the total sales during a period. Next, gross profit. It must grow. To calculate it, subtract the cost of goods sold from the total revenue. Gross profit margin indicates how efficiently a company is managing its production costs. High GPM means the company is keeping more from each sale, while low GPM means it's spending more to produce. Now, operating profit. This should be positive and growing. It measures a company's profitability from its core operations. And operating profit margin or OPM should be high. It's calculated by dividing operating profit by revenue. Moving on to debt levels, this is a critical aspect of stock selection. High debt can be a ticking time bomb, so you need to know how to spot it. The gearing ratio should be less than 0.5 over the past 5 years. It shows the proportion of a company's debt compared to its equity. The lower, the better. And debt servicing ratio, this should be less than 30%. It calculates the ability of a company to meet its debt obligations. So, next time you're eyeing a dividend stock, make sure to run these numbers. It's like having a financial X-ray vision. It's not just about the numbers, management plays a vital role too. Effective capital allocation is like a balancing act, and return on equity, or ROE, is our star performer here. ROE tells us how efficiently a company uses its shareholders' equity to generate profits. A high ROE indicates effective allocation. Now, let's talk dividend policy. This is where a company's management signals its commitment to shareholders. First, we have the stable dividend policy. Companies following this policy aim for consistent dividend payments, rain or shine. It's like having a reliable friend. Then there's the residual dividend policy. Here, the company pays out what's left after reinvesting in growth. It's like saving for a rainy day while also giving you a slice of the pie. And lastly, the constant dividend policy. These companies commit to a fixed dividend amount, ensuring a steady stream of income. So, why does this matter? A company's dividend policy not only impacts your income but also signals its financial health and growth plans. When it comes to valuing dividend growth stocks, we have 3 essential methods in our toolbox. Let's dive right in. First up, dividend yield. This is like the heartbeat of a dividend stock. It tells us how much income you can expect in return for your investment. To calculate it, simply divide the annual dividend per share by the stock's current price. Now, here's a tip: look for dividend yields that are not too high, which could signal trouble, or too low, which might not be worth your while. Balance is the key. Next, we have the price-to-earnings ratio, or P/E ratio. This one helps us understand if a stock is overvalued or undervalued. To calculate it, divide the current stock price by the company's earnings per share. Remember, a lower P/E ratio might indicate a better deal, but it's essential to compare it with industry averages for context. Lastly, margin of safety. To calculate it, subtract the stock's current price from its intrinsic value, then divide by the intrinsic value. A higher margin of safety means you're buying with a buffer against potential losses. Your time and attention mean the world to us. We hope you've gained valuable knowledge and insights that will empower you in your investment endeavors. If you found this video helpful and informative, please hit that like button if you enjoyed the content. If you haven't already, consider subscribing to our channel. By doing so, you'll stay updated on our latest videos, insights, and expert tips.